At 9:34 a.m. on March 18th, the New York Stock Exchange halted all trading for the fourth time in 2 weeks, trapping trillions of dollars in free fall. Retail investors watched their screens turn crimson as decades of wealth evaporated in real time. According to Dalbar's quantitative analysis of investor behavior, during severe market corrections, the average equity investor loses nearly twice as much as the actual index they are invested in. Why? Because they panic, they liquidate, they turn temporary paper drawdowns into permanent, unrecoverable capital destruction. Meanwhile, a very quiet, very specific subset of the population experienced that exact same morning, poured a second cup of coffee, and went out to mow the lawn. They did not log into their brokerage accounts. They did not refresh the financial news. They felt zero cortisol in their veins. The difference between the panicked masses and the lawn mowing minority is not superior intellect. It is not insider knowledge. It is a specific, measurable portfolio size where your financial safety net is finally stronger than your natural instinct to panic. I will show you why the most repeated retirement advice on the internet is quietly setting you up for a psychological nightmare. How a tiny adjustment to a 3.9% framework changes your risk profile entirely, and the exact financial thresholds you must cross to become permanently immune to market chaos. But before we calculate your exact target, we need to dismantle the most famous and deeply flawed assumption in modern wealth building. For decades, financial planners have chanted the exact same mantra. Multiply your annual expenses by 25. Withdraw 4% a year. You are financially independent. You are safe. This is the traditional 4% rule, and mathematically, it usually works on paper, but nobody tells you what usually works feels like in your nervous system. Imagine you are driving an 18-wheeler across a suspension bridge spanning a massive, jagged canyon. The engineers designed the steel cables to support exactly 40 tons of weight. Your truck weighs 39.9 tons. You have done the math. The structural integrity holds. Statistically, based on the tensile strength of the steel, you will make it to the other side. But instead of enjoying the view, you are gripping the steering wheel, running weight calculations in your head every few seconds because you are at the absolute minimum viable threshold of survival. You are not safe, you are merely surviving the crossing. This is the psychological trap where the traditional 25 times expenses rule leaves millions of hardworking people. They hit their target, they quit their jobs, and within 6 months they realize they are entirely at the mercy of the Federal Reserve, global supply chains, and algorithmic trading bots. They lose sleep when the S&P 500 dips 6%. They think they lack emotional discipline. They assume this is a character flaw. It is not a character flaw. The math is the problem. At the survival threshold, your anxiety is a perfectly rational response to a fragile equation. The bridge needs to be thicker. The cables need to be stronger. And for the rest of this breakdown, I will show you exactly how much steel you need to add to that bridge so you can drive across it with absolute peace of mind, never needing to check the rearview mirror. Stay with me, because the next mathematical reality changes everything you believe about building wealth. Before we get to the 3 levels of the 3.9% framework, I need to introduce you to Marcus and David. Not a fable, but a reflection of 2 very real paths taken by software engineers during the late 90s tech boom. Both worked at the same firm. Both saved aggressively for 28 years. Both hit a portfolio of exactly $1 million. I will return to them shortly because what happened to their money reveals the most dangerous blind spot in investing. Hold their $1 million portfolios in your mind. The blind spot is called volatility drag, and it is the absolute assassin of the fragile decade. The fragile decade is the 5 years immediately preceding your retirement and the 5 years immediately following it. During your accumulation phase, when you are simply shoveling money into index funds every 2 weeks, the sequence of market returns is largely irrelevant. If the market drops 30% one year and gains 43% the next, your portfolio recovers. You are buying shares on discount. But the moment you transition from accumulating assets to distributing them, the physics of your money invert entirely. Let's look at the brutal reality of the fragile decade. If you have a $1 million portfolio and the market drops 25%, You are down to $750,000, but the world does not care that the market is down. You still need to pay your property taxes. You still need to buy groceries. So you withdraw $50,000 to live on. Your portfolio is now at $700,000. You have permanently severed 30% of your capital base. When the market eventually rebounds, it is rebounding on a significantly smaller foundation. The shares you sold at the bottom are gone forever. They cannot capture the upside of the recovery. This is why a portfolio can mathematically implode even if the long-term average return of the market remains robust. Two investors can experience the exact same average 7% return over 30 years. But if one experiences the negative years at the beginning of their distribution phase, they go bankrupt. Instead of getting bogged down in the textbook math of asymmetric losses, calculating how a 10% loss requires an 11% gain, or how a 50% drawdown demands a massive 100% rally just to claw back to zero. We need to focus on the rescue mechanism. You need a structural defense that prevents you from ever digging that hole in the first place. You need a system where, even if a 48% rally takes years to materialize, your daily life remains completely uninterrupted. And it is exactly here that the theory meets the unforgiving reality of the market. If you want to permanently bulletproof your retirement against this exact mathematical trap and build a portfolio that thrives in any economy, make sure to subscribe to the channel right now. Building this kind of defense comes down to 3 distinct stages of financial security, and the first is exactly where most people drown. Let's map the full framework with concrete numbers. We will use a baseline lifestyle of $60,000 a year in living expenses. Level 1. The panic line. This is the traditional 25 times expenses rule. For a $60,000 lifestyle, this requires a portfolio of $1.5 million. This equates to a flat 4% withdrawal rate. At this level, the Monte Carlo simulations suggest you have a roughly 85% chance of not running out of money over a 30-year timeline. You are on the fragile suspension bridge. You will probably survive, but you will not be calm. Since 1980, the stock market has experienced an intra-year drop of at least 10% in 22 different calendar years. Almost every single year, you will watch $150,000 evaporate from your screen. Because you are withdrawing 4%, a 20% market correction pushes your effective withdrawal rate to 5% of your new, lower balance. You are now bleeding capital. The human brain is wired for loss aversion. Behavioral economists have proven that the psychological pain of losing a dollar is twice as intense as the pleasure of gaining a dollar. At the panic line, you are constantly fighting your own biology. Your cortisol levels spike every time the Federal Reserve chairman schedules a press conference. You are technically financially independent, but you are emotionally bankrupt. Level 2, the 3.9% shield. This is 25.6 times your annual expenses. For a $60,000 lifestyle, your target is roughly $1,538,000. It sounds like a marginal difference. It is only $38,000 more than the panic line. But mathematically, it changes the entire structural integrity of your wealth. By lowering your withdrawal rate to exactly 3.9%, you aren't just adding a few $1,000s. You are expanding the portfolio just enough to safely carve out a permanent cash buffer without starving your growth engine. You take $120,000, exactly 2 years of living expenses, and hold it in liquid cash or short-term treasury bills, leaving the rest fully invested. When the market drops 30%, which it has done 3 times in the last 2 decades, during the dot-com crash, the 2008 financial crisis, and the 2020 pandemic, you do not sell a single share of equity. You simply spend your cash buffer. You wait. Waiting is the ultimate superpower in investing. Every single major market crash in the history of the United States has been followed by a complete recovery and new all-time highs. The 2020 crash recovered in months. The 2008 crash took years, but patience always pays the premium. At the 3.9% shield, you are no longer a forced seller. You are an observer. The bridge is swaying, but you know the cables are reinforced. You feel the wind, but you do not fear the fall. Level 3. The fortress line. This is 33 times your annual expenses. a flat 3% withdrawal rate. For our $60,000 lifestyle, this requires a portfolio of $2 million. The historical annualized real return of the S&P 500, adjusted for inflation, is roughly 7%. At a 3% withdrawal rate, you are consuming less than half of your portfolio's natural growth engine. In almost every historical scenario, your wealth is expanding faster than you can spend it, even if the market suffers a catastrophic 50% decline, mirroring the absolute worst moments of the 2008 global financial crisis. Your effective withdrawal rate only jumps to 6% temporarily. You are still within the boundaries of survivability. At the fortress line, the stock market becomes background noise. You do not know what the Dow Jones did today. You do not care about inflation reports. You order the expensive wine. You book the upgraded flight. You have built an impenetrable citadel around your time and your dignity. The math proves you are invincible. And finally, your nervous system believes it. But there is a silent killer that threatens to pull you right back down to the panic line: the traditional asset under management fee. If you hire a financial advisor who charges a seemingly harmless 1.2% annual fee, you are secretly adding massive pressure to your withdrawal rate. When you reach retirement and begin withdrawing 4%, that 1.2% fee means you are effectively draining over 5% of your portfolio every year. You are doing all the saving, taking all the risk, enduring all the volatility, and that fee is quietly digging a hole in your foundation. This is why managing your own low-cost index funds is critical to maintaining the fortress line. Now let's return to Marcus and David. Both hit a portfolio of exactly $1 million. Marcus needed $40,000 a year to live. He retired in March of 1999, paid a 1.2% advisor fee, and sat right on the panic line. The dot-com bubble burst. The NASDAQ collapsed by 78%. Marcus's portfolio was crushed because he was paying high fees and forced to sell equities at the absolute bottom to fund his lifestyle. His $1 million evaporated. By 2010, he was completely broke and forced back into the corporate world at age 66. David also retired in March of 1999. He had the exact same $1 million, but he managed his own money using ultra-low-cost index funds and paid zero advisor fees. Most importantly, he optimized his lifestyle to need exactly $39,000 a year. By doing this, he perfectly utilized the 3.9% shield strategy. Instead of leaving his entire million exposed to the market, he carved out $78,000, exactly 2 years of his living expenses, and held it safely in cash, while the remaining balance stayed invested. When the dot-com bubble burst, his equities plummeted right alongside Marcus's. But David did not panic. He did not sell a single share of stock. He simply lived off his cash buffer for 2 years while the market burned. He repeated this exact same defense when the 2008 financial crisis hit. By 2010, the market was recovering, and David's equity portfolio was completely intact. Today, David has more money than the day he retired. Same starting balance, same lifestyle cost, completely different destinies, not because of investment skill, because of the calendar and the exact structural defense he built around his capital. I spent a lot of time going through 5 decades of actual market data, historical drawdowns, and withdrawal mechanics, and I turned it into a comprehensive guide called the Shield Blueprint. It is exactly what you need to build this architecture yourself, available through the link in the description. If you want to permanently escape the anxiety of the panic line and build your own fortress, you must execute these 3 rigid steps today. Step 1. Calculate your exact 3.9% shield number tonight. Take your absolute baseline annual survival expenses, housing, food, healthcare, insurance, and multiply that exact number by 25.6. Do not include vacations or luxury purchases in this baseline. This number is your unbreakable floor. Step 2. Audit your expense ratios immediately. Log into your brokerage account and find the expense ratio of every single fund you own. If you are paying more than 0.2%, you are being robbed. Liquidate the bloated mutual funds and transition to broad market, low cost index funds. Every dollar you save in fees is a dollar that compounds toward your fortress line. Step 3. Build the 2-year cash buffer before you quit your job. Do not cross the threshold into retirement until you have 24 months of living expenses sitting in a high-yield savings account or short-term treasury bills. This is the steel reinforcement for your bridge. This is the mechanism that allows you to sleep through the next market crash. The market will panic again. The screens will turn red, but you will not care.